The U.S. housing market seeing some bright spots. Housing starts in February rising nearly 11%, well above January's revised estimate, with builders benefiting from low inventory and also from mortgage rates softening just a bit. Well, as we head into a pivotal season for home buying, analysts remaining largely bullish on home improvement stocks. Mizuho initiating coverage on both Lowe's and Home Depot with buy ratings, naming Lowe's a top pick. For more on this, we want to bring in David Bellinger. He is Mizuho's America's Director and Senior Analyst. It's great to have you here. So let's start with Lowe's being a top pick within your coverage space right now. What is it about Lowe's that you think better positions that name versus Home Depot, which you also see upside with?
Good morning, and thanks for having me on. So yes, we do like the home improvement space. We are beginning to see some green shoots in these housing numbers, somewhat better housing activity. But we step back and look at Lowe's versus Home Depot. We clearly like both names, but we prefer Lowe's as our top pick within our consumer hardlines coverage and our top pick overall. And what we like here, most especially for Lowe's, is that they've got this bigger do-it-yourself piece of the business. It's about 75% of sales. Home Depot's at about 50%. We think that gives Lowe's better leverage to any early turns in existing home sales. So any homeowner knows once you buy a house, you're typically in these stores every weekend, 2 or 3 years, constantly fixing projects. So Lowe's over-indexes in those categories like paint, outdoor, patio, seasonal categories. So we think that gives Lowe's a bit of a leg up, and we expect comp sales to turn positive towards the back half of this year.
If we don't see what has been dubbed as the, I think, silver tsunami, where there's a wave of baby boomer homeowners that don't list their properties because they want to just sit on that for a little longer and wait for the environment to emerge, where they're seeing multiple and dozens of bids start to come in on a property. If we don't see that come forward, what does that then mean for the amount of buyers that may say, you know what, I'll just go look for a potential new home build out instead, and how that could translate through to Home Depot and Lowe's?
Yeah, good question. And there's no doubt there's been sort of a freeze on housing activity over the past 12 to 24 months. And I think the homeowner or the potential homeowner is looking to get in at a good price. And whether that's existing home sales, new home sales, I think there's a lot of demand out there. We looked at a lot of data. We looked at Google Trends data, and it seems like demand for housing is almost at peak 2021 type levels. So we think there's a lot of demand on the sidelines ready to be unlocked. If we get lower rates, that's a nice added accelerant. But if we also look at just the longer term demand dynamics for home improvement, one key stat, about 50% of the U.S. housing stock right now is aged 40 or older. And these homes tend to be leaky buckets. There's always some kind of maintenance activity you have to put in place. And we projected this number out over the next several decades, and that 50% is steadily moving up towards about 65% by 2050. So you've got a long tailwind of just older houses, potential remodeling activity, and we do see a potential for this sort of renovation renaissance or renovation boom coming over the next several decades. And Home Depot and Lowe's, they're positioning their businesses for this. They're going after the big, complex pro, and that will lead them to have what I view as a pretty elevated sales base for years and years to come.
David, if we do see the Fed delay potentially its first rate cut even further than what the market is pricing in right now, is that going to then have that ripple effect and delay this turnaround or boost that you're expecting to see within housing activity?
Potentially, yes. And I would say that our estimates and our thesis on both of these stocks, we don't necessarily bake in rate cuts before the year ends. And that's in line with our Mizuho macro view. And we spent a lot of time studying this post-pandemic, post-stimulus digestion period, right? Home Depot and Lowe's saw an enormous acceleration in their business. If you're talking about a low to mid-single-digit comp sales number is good for them. There are some months in 2020 where these companies were comping 30, 40%. And that's just unheard of for companies with north of $100 billion sales base. So we spent a lot of time studying this. We think we're at the tail end of this digestion period, and even absent, these rate cuts that, some people are expecting throughout the year, we don't necessarily see that. But as Lowe's and Home Depot lap some of these, easier comparisons that turned south towards the back half of last year, I think if demand stays where it is, you're getting back to flattish, potentially slightly positive low single-digit type comp sales, and that'll give us a better runway into 2025, especially if we do have a more forceful rate cut activity going into next year.
You have a really extensive and interesting coverage list here. I mean, any coverage list that includes Stitch Fix as well as Mr. Car Wash absolutely catches my attention. And Mr. Car Wash is one of your top picks right now. But I want to focus in specifically on Wayfair. Where in this broader kind of homes landscape and where Wayfair fits in to potential home buyers, or even the renaissance that you were talking about, the renovation renaissance that we could see. Where does Wayfair get its legs?
Yeah, absolutely. And our coverage is built to follow the connected consumer and this next wave of digital spending. Who doesn't love a good car wash? But Wayfair does fit in here. This is sort of a secondary call on home improvement, on housing getting better. So Wayfair, we did a very similar digestion phase analysis. We're starting to see some positive inflection in US-based order growth. So the numbers are starting to inflect slightly positive. Wayfair actually had their first year-over-year positive growth number for active customers last quarter, and that was the first time since Q3 of 21. So I think we're getting there. And I don't think the market is fully appreciating a much leaner Wayfair model now. This company clearly overhired through 2020 and 2021. They've cut back somewhere between 20 and 25% of their headcount, and they've pulled out about $2 billion in annualized costs out of the model. So if you do get stabilizing to slightly positive revenue growth into next year, I think you're going to see a rapid profitability improvement for Wayfair. There's bears who will argue that this company might not be structurally profitable. We very much disagree with that, and we see them getting to about a mid-single-digit EBITDA margin this year. They've got a path to get to 10% over the long term. That might be 3-5 years away. But I think if we see stabilizing revenues to slightly positive revenue growth in 2024 and after, this stock has a lot of upside to it.
David, great to have you on here with us today. We know that you've got a lot of companies to keep tabs on, including Five Below later on after the bell. We'll be checking back in the future. Appreciate the time. David Bellinger, who is the Mizuho Americas Director and Senior Analyst.
Thanks so much.